Good evening, everybody. Was anybody here this time last year? Right, okay, so I'll try and say something different this year. But it's really interesting listening to Ian, it's interesting listening to Hinesh. The answer is that there's much to take from both of those, and I'm not going to repeat and agree with everything, but I'm going to agree with quite a lot. But this is Meet the Manager, and therefore you've got two different investment managers in the room, so we can say same things, different things. So I will do a bit of that. But what I wanted to take today is that implementation is everything. There are a lot of smart people out there who talk beautifully, whose eloquence adds absolutely zero return. And every evening you'll see them on the news explaining the present. And I don't live in the present, I live in the future, which makes me rather occasionally vague. So I'm going to express judgments to you with no graphs, not many facts, but I'm very happy to be challenged about things. Because I am an investment manager. I'm one of those people that writes out deal tickets. Well, I don't write them out anymore because we don't do that. We have computers, but you know what I mean. So I actually make decisions. I work for Quilter Cheviot. I was a founding partner of Cheviot. It gives me great satisfaction that we've got in excess of £20 billion of assets for private individuals, people's savings. It's a very serious business. But we started with nothing. And to pick up Ian's point, I was 47 and sitting in the corner office with a title at a big bank, and I was bored to tears. So I walked out, gave away the British Airways gold card, lost the title, you know, and started again with a whole load of other people. And the great thing about our place is that I'm not the only person that's been around too long. We've got people who've done 20, 25 years in markets. It's experience. And we invest directly. We invest directly, and we're in direct contact with our clients. So that has a benefit, which I'll come on to. I've been around since 1980. I also did quite a lot of sport when I was young, and I still do it now I'm old. So I ran the first London Marathon, which was a first, and it was very painful and never again. I still compete in masters swimming, and this year I'm 60, and I'm going to go back and try and win something, because eventually there is survivor bias. Right. But I have responsibility for a lot of stuff. I also started doing something new 4 years ago. I started writing a weekly note, which goes under the title of Diary of a Fund Manager. I just thought I would do it. I sent it to 200 of my closest friends, and I've now done 185 of them. I've written over 150,000 words, and it goes to 23,000 people a week. And that's a real buzz, and I found that I can do something new. I never knew I could. And leading on from that, I get to go on television, which I've never done, all that stuff, and I really don't believe my own publicity. But what the great thing about the weekly diary is that it goes to people, and people write back to me. People tell me stuff, and I'm a great believer that although you could look at me and say, oh, he's an expert or whatever, the answer is that we all know what's going on in the world. We look around, we have opinions. We may not know quite how to put it into context of investment, but it's absolute gold dust for people like me. And it's great. I get this feedback from people. I get, oh, this is what's going on in New Zealand dairy farming. The Chinese are all over the place, and that stuff. How would I know that? By reading a research note from some broker. So that's what we do. Around the world in 80 seconds, and mostly I agree with what Hinesh said, so I won't say it all again. I'll pick up one thing. Too much excitement. Why did the markets go up in January and down in February? Too much excitement. You basically got a US administration that's throwing fuel on the fire of global growth. If it gets out of hand, interest rates go up more than expected. Inflation becomes a problem. Markets don't like that. Investment managers don't like that. 1994 was a disaster. When the Fed got behind the curve, they started putting rates up much quicker. People like me look at that and say, is there inflation or isn't there? Now, if you are an economist, or if you are somebody who thinks that they want to explain the present in a persuasive way, you think there is inflation coming back, I disagree. There are huge disinflationary forces going on in this world around us. There's obviously the emerging economies of the world. There's great change. But the way in which our companies operate is essentially disinflationary. They're trying to bring cheaper things to you. They're trying to bring better things to you cheaper. They build it into their contracts in terms of how they get supplies. It isn't just going to happen because somebody says, I want a pay rise. The answer is, or I want to put the price up in the shop. You put the price up, and you know what? We all know it's the wrong price, and we stop buying. We know it's the wrong price because we have the internet. Lots of change. This is not the 1970s. It just isn't. And anybody who thinks it is, don't worry. My view is that we don't have an inflationary problem. Now, that's an opinion from me as a fund manager. And if I'm wrong, I get to do something about it. I have to change my mind. Isn't that good? I'm not stubborn about things. That's a lesson from 37 years of doing this job. I won't go through the rest of this stuff because a lot of it we've heard already. And if you're all optimistic, then I don't need to persuade you to be pessimistic because I'm actually optimistic about what's going on. So a quick tour of the world. What else can I tell you? It's harder to do it now than it was 20 years ago. You need people like me to do it for you. That's the advert. 20 years ago, you could have put all of your money into US Treasuries and earned 7.5%. Wonderful. Doesn't take a genius to do that. And there's a thing here at the bottom, standard deviation. That's risk. Risk 6%. Don't worry about it. It's the relative that matters. Fast forward to now. Well, I just lifted this from the Wall Street Journal, 2015, but it's the same thing. You have to know about all of this stuff. Bonds, equities around the world, property, private equity, mix it all up, get it right, implement it properly, and don't forget to change it as the world changes. To get your 7.5% that you were getting for no effort 20 years ago. And the risk of doing it's gone up 3 times. I talk to clients, I say, well, how much would you like me to try and make for you? And they say, oh, 6 to 8% should be straightforward. It isn't. It's incredibly difficult now because interest rates are 0. There is no money for leaving your hard-earned savings on deposit at a safe building society like Northern Rock. Right. We all like to follow the soap opera in the States. It matters what's going on in the States. It matters hugely. And for those who were here last year, I showed this one. This is the only one I showed last year. And what it does is it superimposes economies around the world on the states of the United States that have the same economic size, GDP. Okay? You probably can't read the detail. But there's France and there's California. There's Canada and Texas. My particular favorite is Greece, which is, for those who were here last year paying attention, anyone know which state that is? Iowa. Very good, you were paying attention. Iowa has never been thought to be about to bring down the global financial system, all right? Doesn't happen, but it's the same economic size and clout as Greece. These are extraordinary things. This is an incredibly important economy. It's a single market. It has a federal system where they subsidize each other. It sort of works. And if you ignore that, you do ignore it at your peril. There are 250 million people with a lot of money and they spend. Really important. And then on top of that, they have the 5 biggest companies in the world. And none of those 5 companies existed when I started work. This is an extraordinary period of change. 90% of us access the internet through Google. 50% of us don't bother going and buying something from a retailer that we've heard of. We just go to Amazon because we can't be bothered going anywhere else. 12 million websites are shared every day on Facebook. This is huge. This is huge. And it's destroying businesses that don't get with the program. You know, we all know what Amazon is doing to the retail sector, and it's happening around the world. But we're not talking about small changes. I came across a company that makes cosmetics, face cream. So, you know, and I know a bit about that because Croda, for example, supplies the ingredients to L'Oreal, and L'Oreal says this is wonderful. We put our magic on top, and we'll charge you £70 for a pot of the face cream. It's all, marketing, but you buy the brand. This company called Beauty Pie, it's a great name. It's like Tweety Pie, so I can never forget it. Doesn't deliver the face cream for £2 less. It does it for £7 a pot. Now, you might think you don't want to use that on your face, but the fact is that somebody does try it for £7. They stuff it out over Facebook, and this business just destroys the brand because it's a great product, apparently, and it's 1/10 of the price. All of that is happening because of the innovation driven through from here, Silicon Valley, and it's changing the world, and that's fascinating and very exciting. The other thing I'll say to you is that lots of things in the world don't matter to me, and I'm not being immoral or amoral about it, but lots of things are economically irrelevant. But if you remember last autumn, Houston got flooded. And funnily enough, American politics changed because Houston got flooded. Now, why? Well, the Houston area is the 23rd largest economy in the world. And if you put it under 6 feet of water, it matters. It matters, all right? Far more than other things that are going on. And Houston is larger than Sweden and Nigeria, all right? Putting everything in perspective. Oh, I've said enough. 10 years since the credit crunch. People say to me, oh, the market's gone up a lot, it's too expensive to buy. Well, the world has changed in 10 years, I can tell you. And I'll just give you a few facts. In my view, the iPhone was 3 months old. There were 50 million Facebook subscribers, and there are now 2 billion. Online banking's gone up 30%, 70%. If Robert Peston stood up at 10 o'clock in the BBC News, there wouldn't be an orderly British queue outside the banks the next morning. It will be all over by 10:01. All right? It's changed. There are 1 million fewer beneficiaries of final salary pensions. All right? That's why you need Ablestoke to advise you on all this stuff. The banks are taking less risk. Lots more rules. They're more sober. They've been sobered up by the mistakes. So where is the risk in markets? The risk in markets is with people who are unadvised, ill-informed. There's still risk out there. We see it all the time. It isn't sitting with some big institution, it's sitting with all of us, and that's the issue. I think government's had a good credit crunch, by the way, with the benefit of 10 years hindsight. I have, I suppose, less confidence about the current incumbents. And we are still living with the consequences of the past. The reason that voters are voting the way they do all around the world is because of this, 10 years on. But it's not a disaster, it's just changed, it's different. Navigating uncertainty, the theme of this evening. I wanted to make the point about uncertainty because it's really important that it doesn't put you off. It doesn't seem to be putting you off investing, but a lot of people have been put off investing because everybody has a shopping list of things that are wrong with the world. I'll make a couple of points that matter to me, I think. And the first one does take some explanation. When the middle ground is empty, the average is meaningless. Lots of people will talk about GDP or inflation or the market rating. Is the market expensive? These are all averages, all right? It's people who grew up thinking that the world is like one of those bell curves. You know, you have the most of it is in the middle, and then it goes out to the tails, and therefore the average matters. What do we see around us these days? We see wealth inequality. If you're a company, you better know who you're trying to sell to, the rich people or the poor people, because there aren't any people in the middle, okay? If you want to get a vote, if you want to be elected, we see it all the time. You don't want to be the consensus person in the middle, do you? It seems the only way to get a vote is to be one there or there. The middle ground has been hollowed out, and therefore investment is about identifying what is important. I'm not justifying it one way or the other, but there's absolutely no point focusing your attention on the completely empty bit in the middle. Sounds very straightforward if I say it like this, but all day, every day, everyone talks about the average, right? Remember that bit. Structural change, I talked about that. Security selection is absolutely critical, all right? Now we know Toys R Us and Maplin went bust yesterday, all right? Awful. Not surprising. You know, because who goes to Toys R Us except between September and Christmas, for example? Well, obviously not enough of us. There are companies out there who supply the toys to us, buyers, at the time we want it, at cheaper prices. No wonder the specialist retailers are going out of business. You can lose a lot of money forgetting that there's change out there. Reversion to the mean is not working if you're in business. And people like me do things like we like to pick stocks. We like to think that's a good company, and there's a good plan there, that's a bad company. I think it's shameful that Carillion went down, that 30% of the shares of Carillion, when it went bust, were owned by private individuals buying them through platforms with no advice because they thought it had gone down, it was cheap. Nonsense, all right? And next few years will be tricky. It's not going to be an easy time. The valuations are highish. Interest rates could go up. Geopolitical change has become routine, but it doesn't mean it's not dangerous. It just hasn't had any effect as yet. And as I said, watching for signs of overheating and inflation is my main priority. If I get that call right this year, I'm going to do well for my clients. And it's not an easy one. And every day there is evidence coming out, which I have to pay attention to. And just as any good decision, something will tip us one way or t'other. And as I said earlier, my main view at the moment is that there isn't that much of a problem. But I don't mind if I'm wrong. I'll just change my policies, investments. So as we start the third month of this year now, what was working in 2016, 17 is still working this year. Earnings growth, find companies that are doing a good job, put some money in, they're paying dividends. Rio Tinto paid £5.2 billion to shareholders, biggest ever dividend. These are extraordinary amounts of money being handed back to the owners of capital, savers. And it's economics, not politics. You know, I skimmed over the Brexit point because Hinesh said what I would have said, which is we don't know what's going to happen. But as you know, I mean, to throw it back at the Prime Minister, I regard my clients and their portfolios as citizens of the world. We don't care, really. We can go off and do something else around the world if we want to. Doesn't mean I don't care about it as a citizen and a taxpayer and all that stuff. But as an investment manager on behalf of my clients, I don't have to care. Ensuring your objectives are synchronized with what markets can deliver is really important. So since I started work in 1980, there have been 27 years when the market's gone down at least 10% during one of those years. So 27 years out of 37, there's been a 10% setback. You know, but the market has gone up 17.5 times since I started work. Who cares about the 10% setback we saw in early February if it gets reversed? What you don't want to do is sell for no good reason. And if you're about to have if you're borrowing money to invest, or if you're about to spend money on something and you get caught by it, it's really painful. If you don't care about that, you can ride through it. And I would say, to finish off, that the world, and this is a highly technical term, I did do a science degree, so I could talk about uncertainty and chaos to bore you. The real world is always messy, always messy. There is never certainty. What we do is we operate within a sphere of uncertainty, and we try to work hard on understanding how big that sphere of uncertainty is. But it's not a problem that it's uncertain. That's where the opportunity comes from. And I get quite annoyed by those who do present certainty as a fact, because I think they're misguided. I don't think they really understand how the world operates. Those are a few comments. I try to lift the veil on what people like me are thinking, as opposed to, you know, buy this, sell that, whatever. Because what we are thinking is the way that it is developing over time. It's how we manage money and how money should be managed. Thank you very much.